All right, guys, welcome back to episode 3 of the Press Finance podcast. We've got a very special guest today, James, good friend of mine. He's an accountant. He's built many businesses to very impressive positions, and I'm very excited for this one today. So, James, give us a rundown. Who are you?
I guess I'm an accounting and advisory firm at the moment. So I've been back in that space for around 12 years. Prior to that, I've run my own engineering businesses and specialised in company turnaround work. So I've seen the ins and outs of, I guess, the best and the worst, and learnt from my own mistakes, which I now try and share with the people around me and my clients. So hopefully we don't make the same mistakes, but I keep making them so they keep learning.
That's all it is, eh? So today I want to talk about like personal finance hurdles and different structuring and stuff like that inside of, obviously there's a lot of things that you can do to purchase property and different structures you can use to do that. I want to see what your opinions are on some of these structures and talk a little bit about personal finance mistakes if you see them often, which I'm sure you do. First one's, what's the most common finance mistake you see people doing in their personal life? Like obviously a constant issue you see coming up.
I'd say borrowing before they can afford it. So whether it's holidays, borrowing for consumables is probably the best example. I guess it is old school. You should save up and then spend, not spend before you actually had the money. And once they get into that debt cycle, they stay in it. And the whole system's designed to keep you there.
100%. And obviously when you're unpacking people's finances, you see a lot of bad things that come from business owners spending and people just treating money that could come out of a business that isn't theirs, and they're treating it like it's theirs. Well, what are you seeing that a lot? Is it becoming more of a problem for you, in your clients, that people sort of making bad mistakes and spending money they shouldn't?
Yeah, I'd say we put a lot into education. So I do a lot with startups, companies that are in trouble, or companies that are wanting to grow, and we help them in that arena. I guess we do our best at the tax minimisation, but the thing is, they've got to realise whether it's in a company or a trust or in some entity, it's not their money. They are their own entities, and you have to pay your super, you have to pay your taxes before you actually take the money out. Just because there's a couple $100,000 in the bank account doesn't mean it's actually there to spend. Make sure your debts are paid first, and again, it's that discipline of going, pay your debts first, pay your employees especially first, their super, meet your obligations, and then what's left, that's what you've got.
Yep.
And then, again, if they just take it out, they don't take it as wages. Everyone these days has heard of Div 7A loans and things like that. It's just bad practice. And I think, they were common practices 8-10 years ago. The way the world is today and the way information flows, you can't do it anymore.
100%.
It's either income or it's a proper loan. It's not magic money.
Yep. And when you see people in this position, what's a step they can take to sort of unravel themselves from that?
Again, it's most of the time it's discipline. Pay back the money. Don't get there in the first place. Actually understand what your business is making, what the actual costs are. Get a good accountant. Don't believe you're an accountant either. Yep. Good information allows for good decision making. And if the decision isn't just what you read, you actually understand the complexities, because nothing just sits in its own right.
Yep. And touching on that, obviously, there's a lot of dodgy accounting. That word comes out a lot when you're talking about accountants. Are you seeing more of that in the industry? Maybe underqualified accountants or bad advice, just things like that coming out a lot more?
Dodgy accountants. Dodgy accountants used to come back to where you could do things and you were getting away with probably not paying the tax you should have. Okay, so these days it's more about accountants that actually don't have the knowledge. Okay, the systems and processes are in place, the software is there, and not all accountants are the same. Not all have the same knowledge base, and quite often they have different specialities. So it's about finding the right fit for your own business, and then there's no sense in going to an accountant and not listening to them. So you can pay me as much as you want, but if you're not going to listen to me,
exactly.
I get bored with that. But you find people themselves are dodgy in that they think they know the rules, they think they can, they think they're accountants, or they think they're tax accountants. They think they can use Xero or MyOb or something like that, and that is all there is to it. There's not. Or they think, oh, Xero at the moment's got AI built into it. It's all self-learning stuff. It's not actually interpreting everything that's actually happening around you. Our job in my firm is to do our job as an accountant, as compliance accountants, and also as advisors, and get our clients empowered to push ahead in what they're really good at. And the ones that allow that, their business flourish. They'll let us do our job.
No, that's great.
Yep.
And obviously, a lot of write-offs and things like that. You hear a lot of these crazy stories where people try to write off, really outlandish stuff. Are you seeing more of that as well from, maybe online advice? Obviously, you see all those Instagram reels and stuff like that of people saying they write off this and that. Like, are you seeing people coming into this industry thinking that there's so much more they can write off than there actually is?
Yes and no. I think the difference, everything that you spend to make a claim for has to be utilised to help generate income. Okay? And that's a really easy nexus to look at. And that's in its simplest form. There's obviously a lot more around those things. We teach our clients to talk to us and get the correct interpretation of the correct decision making. We find that the biggest change is things that, like yourself, and podcasts, and we have YouTubers and Instagram people and all those types of things. There's a whole new range of deductions, which is outside of the normal business scope. So it's not all that cut and dry. So, we still have to research and find and give the correct explanation. So I would say it's not more claim or more variation. It's more understanding the new ways people are earning money and then working out what is the connection between those expenses and how they're earning that money.
Yep. And I feel like there would be a lot of that, especially all these different types of businesses coming out, that there's all these different types of work expenses and not work expenses. What are the sort of punishments or steps that have to unravel if you make a bad decision with a purchase or maybe bad tax advice? What sort of happens around that?
Bad decision with a purchase. So again, I'll go to education on that.
Yep.
Especially major purchases and things, we educate our clients to call us. Okay, before they do it. We can then decide what is the best way to purchase it, what can be the tax treatment of it before they purchase it. And it might be, they might have the cash to buy it, but we might send it to someone like you to say, go and finance it because the cash in the bank is better than forking it all out. So they can keep the 100 grand to use it to keep investing and creating money, where you can lend them the 100 grand, pay it off over 5 years, and they can get a return on both lots of money then. So they're things that people often don't think about. So if they ask us beforehand, that's where people like us can work together to get the best outcome for a client.
Yeah. And obviously let's take it a little bit back towards your personal finances, right? So obviously you've learned a lot over the years. You've done it for a million years, judging by the grades on your face. You're stressed out. What have you learned the most in your own journey, like say, that's changed your finance goals and the way you look at money? Does that make sense?
I've probably always been a good saver. So when you don't have a lot of money, you actually learn to spend it frugally. So, I think the biggest thing people need to learn is, especially when you're starting out, if you have a saving pattern, that's really important. If you then get a pay rise, that doesn't mean you just go and spend that pay rise. Keep saving. If you're able to live on whatever you budgeted for, and then you've got maybe an extra $100 a week from a pay rise, save that $100. Don't go and spend it, or save 75 of it, but don't go, oh, I've got extra this. I'll just go and do whatever I want. That just that's like, you see that, and that's, you won't get ahead.
Oh, absolutely. And there's a lot of ways you can spend your money at the moment. There's all these different schemes. You can do your afterpays and stuff. You can spend the money before you even got it. So, and I'm sure you see it a lot, and it's something that people need to be educated on, that just because you earn a little bit extra than you previously have, that's a huge savings tool you could use, but instead you're blowing it on eating out and random stuff like that. So we see it all the time as well. I'd like to draw our attention back into maybe structuring and things like that. So one of the big things that not many people realize that is a tool is your super fund. You can do things like turn your super fund into a self-managed super fund and go and invest through that. Let's talk about that. What's your opinion on SMSFs and that sort of stuff?
Okay, so SMSFs, it's a very disciplined, complicated area. I would say, it is, as accountants, we don't give advice around SMSFs and investments and all those types of things. You go to financial planners. On that, make sure if you go to somebody that it's registered, they are registered, and they'll ensure that you're compliant. Clients can come to us and ask us to set up a self-managed super fund. We will then go through and see what education they have about it, what was the driver of it. There's been a lot of people get involved with SMSFs which have been, for want of a better word, not tricked, but they've got into them based on property spruikers or boiler room type sales and things like that. And they're normally self-generating for the spruiker, okay, and people can lose their money.
Yep.
People can make money, but also lose. So it's just one of those things when you're dealing with any money whatsoever, you go and investigate it. But remember, super is for when you retire. Your age, you wouldn't be thinking about your super.
What's super?
Yeah, that's right. And it's probably not until mid-40s.
Yep.
A lot of people don't even recognise, or they don't, the term I look at it, they don't recognise it as real money.
Yeah.
It is real money.
It is, it's there.
You get to my age, you start going, what's my super balance? What did I do with all that money?
Yeah.
But it is something, I think if you can learn early, one, whether you're in an industry fund or not, you can adjust your investment strategies. I think if you're educated and you want to learn the responsibility of managing your own super, well, self-managed super funds are an avenue. And, a lot of people have different reasons for wanting to do that. And that is sometimes, industry funds or other funds can be taking a lot of different fees and things out of it. If you are educated around your investments and things like that, you can make your own investment decisions. We see people purchasing all types of different things, but the aim is for it to make money. People aren't always feeling secure with the stock market.
Yep.
Okay, so they might look at property. They might look at physical gold and silver. They might look at different types of investment bonds. They could buy a work of art, a luxury car or something like that. But there's all rules around those things. And with a super fund, if you buy a work of art, you can't hang it in your own house.
Yes.
Okay?
And not many people realise that you can't.
No, that's right. It's got to be insured and things
Exactly.
like that.
Yep.
So we've seen people buy a work of art, but then it's part of a pool that is a specialised pool where they rent those pieces of art out. They get an income, but they're also getting the value increase in the actual artwork.
Yep.
Okay. You can buy a luxury car, but you can't have it in your garage. Even to look at it,
drive it around on the weekend.
You can't drive it around. So, and each item, there's rules around it.
Yep.
Okay, but on the other side, if you wanted to buy your own office, you could use a self-managed super fund to buy the office.
Yep, for the business,
and generate an income. So we see a lot of factories and things like that. Another one we're seeing more of is, again, as you're getting closer to retirement, one of the strategies has been, with the way property prices are moving, they can buy a unit that they can see themselves retiring in, okay, and might be 10, 15, 20 years down the track. So they'll buy that unit, rent it out as per the laws and regulations, with the aim that that'll end up being part of their super pool, of which when they get paid out, they'll actually end up being able to live there.
Yep. And that does touch on the next question. Is it true that you can't live in or personally benefit from your SMSF?
Yes.
Yes.
Or your relatives, or
Yep.
your best mate.
Yeah, you can't,
Really,
can't rent it out to your
it's
sister.
It's relationship.
Yep,
based,
yep.
Okay, so and a lot of that is because people are doing it, and you might have paid half the rent. Or the thing is, it's there to build wealth. It's there to pay for your retirement. It's there to stop the government having to pay for your retirement, and that's what they want.
Yep.
And they want it protected.
Don't try to do loopholes and put your cousin in there and live there with them.
Well, it's not the 80s anymore too, and the transparency of information and things, that's probably the biggest matter what entity, no matter what thing you're doing, there's so much digital trail out there.
Yeah.
There's so much information that ATO or government bodies or anyone can trace, that if you're going to try something that you're going to get away with it, you're not. It's only going to be a matter of time.
Yep.
And would I risk my practice with someone like that? Not a chance.
Exactly. Coming back, so when you are investing in your super, maybe let's explain to the audience where the income comes from your super. Obviously, not many people realize that your super technically does earn an income. It's the contributions, and that is what's used in, when we assess borrowing and things like that. Obviously, you'll see it a lot, but what are things that people don't realize that they can do with SMSFs, and when they, unravel that, they go, oh wow, I didn't realize this is how it works.
Okay, so obviously you got the income. As an employer,
Yep.
we pay a percentage of superannuation.
Yep.
So my first thing, and other employers are going to hate this, but is to all employees, make sure your super's paid. That's I won't take on clients who won't pay their employees super first, or every now and again, people get in trouble, but if anyone purposely is spending the employee's super rather than the circumstance, but if it's a deliberate thing or it's a constant thing, I'm not interested, because I guess on that one, if your staff aren't happy, you're not going to have a good business anyway.
Exactly.
But I see so many times that staff don't keep an eye on getting their super in. Now that compounds and builds up. Obviously, two things: the government will take 15% of it, and an industry fund will take a percentage of it. The things people forget is that they actually do have a say in the mix of investment. So it could be high yield, it could be cash, it could be safety. There's all different mixes. Yep. So you've got to decide what mix you would like. Okay, and there should be someone to talk to, especially an industry fund, who can help guide those types of things. The other thing is normally you'd have life insurance inside there, and it's important to keep that and keep a check on what you actually are being charged for those types of things.
Yep.
Once you move into self-managed super fund, often people forget that they've still got to pay life insurances and all those types of things. Yep. So we'll see quite often they'll keep an industry fund going, plus have their own self-managed super fund for very particular reasons of what they wanted to buy or invest in. Once you have other or buy assets, whether it's a property, obviously it's going to
Reduce rental income.
Get rent and slowly grow, and your capital gains will come through. It's not a given as well. So we all hear in the media about possible changes to legislation, possible all this stuff. So things can change at any time. So
You're
you
always
can
trying
talk
to
about
attack
what's
it.
happening today.
Exactly.
Well, government, our politicians, I think, get quite a good deal with their supers
absolutely.
and things like that.
Yep.
So there's different agendas for different reasons.
Yep. Exactly. So what you're saying is pretty much SMSF isn't a get-rich-quick scheme. It's like a retirement strategy, and don't use it for a get-rich-quick, because it's not that, and it doesn't work like that at all.
100%.
Yep.
Well, at the moment, you're probably not sure what age you have to be, but most people have to be around 67 to have access to it. There's different rules what happens when you retire at 60. There's all... It's actually quite a complicated space.
Yeah.
So again, you get the right advice. There are, you can top it up. There's contributions that you're allowed to make. There's different times as business owners. If we sell out, we can actually top up our supers and things like that. So there's some good things, but the whole idea is to have a nest egg that is going to allow you to retire, that complements the pension.
Yep.
I would say that's the best way to put it. It's not there to try and blow along the way.
Yep.
Okay.
Yep.
And I've seen it blown. I've seen it.
Yep.
And I've also seen it made real good money.
Yeah,
well.
100%. Yeah. What are some of the biggest mistakes you see in this field? Obviously, people making purchases and stuff they're not supposed to with money that's technically still not theirs. Are you seeing that a lot?
Not a lot, no. So the thing with self-managed super funds, they also get audited every year. Okay. And obviously we try and educate people. Again, it's not their money.
Yep.
Unfortunately, we've seen couples split. You know, one might all of a sudden grab the cash or whatever, and
It's mine.
rather than letting the courts or whoever
Yep.
else sort
Nice.
it out. You know, as I say, cash is king. So someone goes and raises the account, then you know you've got to try and get it back, or
Definitely.
you know, there's penalties involved for taking super and not using it right. There's some good strict regulations, and as there should be. But yeah, that having access to a bank account.
Yeah, with a lot of money in it.
Well,
sometimes.
money, unfortunately, we've seen it taken by gambling and all those types of things. So
Bad stuff.
you just don't know. So
Yeah.
the best thing is have some checks and balances around it. So if you're in a self-managed super fund with somebody else, make it 2 signatures or those types of things.
Yeah, make it a little bit harder to.
Well, it is.
To make
As
decisions.
you should always.
100%. Yeah. People should do that with their big savings accounts.
That's
everyone
right,
has.
yeah.
Yeah. There's so many times you see people unravel themselves because they go, I got the money. It's all right. I got the money. And that's how it all unravels really quick. So as you touched on a little bit earlier, it doesn't have to be property. Obviously, people can choose at the end of the day what they invest in. What's some crazy example you've seen somebody use their SMSF for? It's something that's like, a unique little idea they've had.
Unique. Okay. Some of the best returns I've seen, especially lately, is people who bought physical gold and silver.
Yep.
But with those things, you get insurances and where it's kept and those types of things. It's all regulated. But they've got some good returns on those things. And it was hard, I think, for financial planners to give guidance to buy some of those things. Mm-hmm. But, hindsight's a great thing.
Absolutely.
So,
hindsight is a great thing.
I've seen, shares purchased in, I guess, unlisted companies, which have gone exceptionally well. Mm-hmm. But they've known, again, I'm not a financial planner. I know investment advice. I make that really clear on that.
This is not financial advice.
Yes, 100% not. But you see people who have a good sense of money, and they know it's for the long term, and they make some really good long term decisions with it. And when it comes off, it's really good. Yep. I've seen others who, they've wanted to rush into something. They've been properties quite often, or someone else has told them they could do something, and that's not the right reasons
100%.
to go into it. So we don't find. It's probably early 40s type thing. We see people probably with the balances as well. It's not cheap to have your own self-managed super fund. No. It has to be audited. Mm-hmm. Obviously, it has to have proper sets of accounts. So there's a cost to it. So, unless you're going to get a certain return, you've got to weigh up, is it more expensive to run my own self-managed super fund, or is it more, say, an industry fund? Mm-hmm. So there's lots of things that have got to come into your decision making on it. But yeah, I've seen people, as I said, gems, gold, silver, works of art.
Yep.
Prestige car or what do you call it? Not antique cars. What do you call it?
Collectors cars.
Yeah, collectors cars.
Yeah.
But I always find it hard too. With a collector's car, you actually want it seen.
Exactly. But it's got to get locked up.
It's got to get locked up or whatever. And and I don't know enough about that space. So.
No, that's fair enough. So company and trust structures, that's becoming a little bit more widely known. I would say it's a lot more popular nowadays. Are you seeing it a lot more than previously, or is it sort of a...
For what purpose?
Like for purchasing property and investing and things like that?
I guess we look at structuring. Mm-hmm. Okay, so there comes a time where the majority of our clients are in business.
Yep.
Okay, or family groups related to business. You come to me as a startup. Mm-hmm. You go through this journey of building your own business. You then, when you've got your principal place of residence or investment property, we then start looking at structuring. Okay, someone just walking in cold and saying, "I'm going to buy a property and I'm going to put it into an entity." No, I don't get a lot of that.
Yep.
But as part of a long-term strategy, both for asset protection, we look at those things quite a lot, especially, I guess, we've got the baby boomers. We're about to hit the biggest generation of wealth transfer.
Wealthiest, yep.
Okay, so a lot of the things with acquiring assets now, say if you're in your 50s or late 40s, you can structure it up so that it really doesn't become part of the big pool of funds, of which are now being attacked quite a lot.
Yep.
A lot of wills are being contested and all those types of things.
Yep.
So if you're already structured in trusts and certain things, they're not going to be attacked because they actually don't form part of your own estate.
Yep.
Because they are their own entities.
Exactly.
Okay?
Yep.
So we see it used a lot more for those types of things, but no one who is straight off the street going to buy their first property.
Yep.
These things, banks have tightened up because I think there's been some promotions out there.
Absolutely, there's a lot of gurus online pumping it.
But there's a lot to it. Like it costs to run a trust, costs to run
Absolutely,
a company.
yeah, it's not cheap. Yeah.
And the banks aren't silly. They're very good at ensuring they'll always get their money.
Absolutely.
So
Well,
whatever structure or individual, they're going to make sure they're going to get their money back.
Absolutely. And a lot of people do, they get sold a dream, or they hear people online, promote a specific structure and they go, I want to do that. And then when you start to unpack it, you realize there's costs, there's rules. And like you said earlier, the banks are tightening up. There's a lot of the bigger lenders that aren't looking at it at all. Obviously, you got your tier 2 and tier 3 lenders that will still probably always do it because there'll be a gap in the market. But there's a lot of rules around it now, and there will continue to be more rules coming into place. So yeah, you got to be up to date with all that sort of stuff.
But how about yourself? So if someone came to you, mid-20s, about to buy their first place and said, I want to buy it in a trust, what would you say?
Why? Yeah, it depends. Obviously, there's people that have come to me and said that, but it depends. If they're trying to take more of an investor approach, they've got specific goals in mind, then it's something we consult with an accountant and financial planner about, and we come up with a strategy together, not something that we sort of just come off the street and go, this is how it's done, and then we'll implement that. It's not how it works.
And I think that's really important. So we work closely, so with yourself, with a financier, obviously lawyers and stuff as well, but it takes the whole group to actually make good decisions.
It does, yeah.
I always, if someone comes up and tries to tell me my job, I always listen, and then I'll shake hand. I'll never really come back. The same as, if I talk to you about structuring for certain reasons and you say, James, this is the flavour, this is where different things are at, and I go, no, I'm going to do it this way. Yeah. My chances of getting the finance are going to be 0 to none. Exactly. So why wouldn't I listen? Yeah. I'd say if people are interested in using different vehicles, talk to your accountant, talk to your finance guy.
Consult professionals.
Every time.
Absolutely.
Because, what they say at the pub doesn't always make the...
No, exactly, yeah. What you're scrolling and seeing on TikTok or some random mate's told you on a night out.
Most of these things are there for other people to make money. That's the reality.
Absolutely,
We all bombarded with people who say they've gotten rich from multiple properties and all these types of things, or just every day, but use your common sense.
Exactly. There's a lot to it, yeah. And it's not just these things can't be knee-jerk reactions. They've got to be thought out plans, written down and understood, because a lot of the time they're not. And that's how people unravel themselves into really, really, really expensive and bad financial situations. So.
But you asked before, if I was younger, what I'd do different.
Oh, yeah, I got it.
But it's good advice early.
Yeah, exactly.
You're very good. You network well, and you've met some of my, I guess, different people that I network with and things like that.
Yep.
And they're happy to give the advice. They're happy to share
Most people are.
knowledge.
Yeah. Yep.
And I think it's important that people, recognise that there's other people out there that actually they've studied hard, they've trained hard, they've experienced, and get the advice.
Exactly. Yeah. Most of the time, the professionals know their shit, so talk to them. But yeah, anyway, so we'll wrap it up with this final question, which I want to start asking people as a guest, so I can sort of gauge a little bit of, maybe a little bit of a motivational clip for the end of everyone's podcast when they watch. If you were 18 again and you knew everything you know today, what would you do differently?
Wear a condom.
Wear a condom? There you go, viral.
You can do that.
Yeah, here's something the accountant hasn't told
I've
you.
had a great journey. My biggest thing has been listening to others.
Listen to others,
I'm very big on recognising what I don't know and seeking advice, but still use your own intelligence. But yeah, recognise what you don't know, ask the questions. And if it sounds too good, normally it is.
Yeah, 100%.
Okay.
Yep.
Yeah, but ask and recognise what you don't know.
100%. Yep. If it's too good to be true, normally is.
Normally
And
is,
yeah,
yeah.
you don't learn that until you're a little bit older.
Oh, you never learn something.
Sometimes, yeah, that's true. Some people haven't.
Yeah.
All right. No, awesome. Thank you so much for coming on, and definitely keen to do this again.
next time.
All right. Enjoy.
Okay, cool.
Yep.